Xerfi Global has recently published a report on world mining groups who are currently operating in a market tainted by uncertainty, volatility, and oversupply. This deteriorating operating environment is reflected in mining groups' 2015 profit margins when compared with average profit margins over the last 5 years. 2015 has indeed entered the industry's history as one of the less profitable for most major mining groups, which struggled against dropping global demand for metals and minerals. Groups such as BHP Billiton, Codelco or Vale saw their profit margins cut by half of what they had averaged from 2011 to 2015. Yet other major miners suffered worse fates and endured high operating losses. Such was the case of Anglo America, Barrick Gold or Freeport-McMoRan. So what is behind this slump in the industry? China's slowdown is one of the major factors. The Middle Kingdom has come to be the center of gravity of the mining business, generating over 45% of global demand for minerals and metals in 2014, as, up until recently, during its economic heyday, China had an insatiable hunger for commodities. This unprecedented demand created a commodity supercycle, and miners invested heavily to expand production and ensure they could get on the high-demand, high-price bandwagon. All good things must, however, come to an end, and China's frantic growth is no exception. Its economic slowdown and structural shift away from manufacturing and exports to internal consumption is nevertheless a hard blow for the industry, pulling down demand for metals and minerals and leading to an oversupplied market and collapsed prices. Indeed, metal and mineral prices are admittedly no strangers to volatility, but they have been on a particularly slippery slide since the end of 2014, dragging down miners' revenues. Furthermore, currency devaluations in major metal and mining producing countries have added salt to the wound. In this depressed environment, competition among leading mining groups is heating up and companies are making strategic moves accordingly. Supply is being adjusted, although not always downwards in line with demand. While it is true that some of the leaders have cut back production of certain commodities and capital expenditure in an attempt to sustain prices and margins, others have forged ahead with planned expansion in the hope of sustaining revenues and market share. At the same time, portfolios are being reviewed and players are disposing unprofitable and non-core assets while acquisitions continue, but in a perhaps more targeted fashion. Cost-cutting moves such as workforce reductions and research and development belt-tightening are also being seen. And in these lean times, partnerships and joint ventures are welcome to share research and operating costs and mitigate risk.